Hey gang, on this episode of Investment School, we're going to be talking about something a little different. Not so much about the investments, but more specifically, efficiency with your investments. Stick around. All right, so we had a recent podcast that we did. We're going to link it down below because we really covered a whole bunch of ground on this one, talking about efficiency in investing. Now, efficiency is an interesting concept for a lot of folks because it can mean a number of things. We can be talking about everything from, is it more efficient for me to hire somebody else or do it myself? Or we could be talking about efficiency of the different types of investments within the marketplace. We could also be talking about the efficiency of different asset classes and how you manage them. As an example, S&P 500 as a category is looked at by lots and lots of people. You can find S&P 500 index funds or exchange traded funds created by all kinds of different vendors. That is an asset class that is highly efficient because there's so many eyeballs staring at it. Lots of data, lots of analysts. So finding efficiencies or exploitations in that world is actually really tough. On the other hand, you may be looking at something like investing in an emerging market. Maybe you're looking at China or Brazil or India or some place where they don't have the same accounting standards as we do here in the United States, and it's much harder to figure out what's a great investment versus a not so great investment because the research standards are different, the accounting is different, the currencies are different. So in that case, there may actually be some room for, we'll call it exploitation, but it's basically taking advantage of a dislocation in the market or an inefficiency and then capitalizing on that as an investor. So how we do it it really depends on what you need and what scale you're playing in. If you can literally go to India and do your own research, that may be great. But for a lot of us, that's not very realistic as investors. So instead, we can partner with an expert in that environment, right? And now there may be a difference between, say, an index that simply has a formula for how they invest in India versus finding an active management group that goes out and does hands-on research and looks for those specific advantages. But the difference between how those two operate will come down to, in many cases, efficiency. So efficiency is not equal across the board. You want to look at the various types of investment classes, whether it be fixed income, whether it be stocks, whether it be real estate. There's a whole bunch of different types of assets out there, and they're not all created equal. So the trick here and the takeaway is, as you are doing your research, you want to first look to compare, when you're looking at something, compare total all-in costs, look at total returns, and look at the total volatility or risk that you took to get those returns. And the cocktail that suits you best should be the most efficient strategy for you. As always, if you've got additional questions, check us out in the comments below. You can follow up with us on the various social media environments, or you can definitely call our office. And also, we encourage you, please do the like, subscribe thing, tell a friend, all that good stuff as we're getting the message out. Our goal here is to help everybody out there become better investors. So thanks for joining us. Until next time, this has been David Littlejohn with Investment School.